Welcome back to the Wealth Hub IQ. 5 normal money habits that keep you poor. Over 40% of our daily actions are just mindless and habitual. When it comes to personal finances, that percentage is probably much higher because many people make illogical financial decisions. In this video, I'll share 5 common money habits that people have which end up making them poor. Let's dive in. Number 1, spend credit, pay off debt. Many people choose to spend money they get from a credit lender in the form of a credit card or a loan. This causes prices to be inflated because the interest rates from these credit lenders are often high. For example, a person might spend £700 or $700 on a TV using credit compared to spending £500 or $500 using their own money. To avoid this toxic financial habit, it is important to have patience in your life. Take the time to save money, and once you have enough money saved, then you can buy whatever you want without having to pay high interest rates. So with this, we have to also talk about the connotation between the psychology of instant gratification. So in this society, in this technological world where social media rules, we see how people love instant gratification. They love the new TV, they love the new car so that they can post it on social media. They love the designer clothes or the expensive jewelry so that they can post it straight away and get that instant gratification. However, if you want to cultivate a wealth mindset, that is truly not important. And instead, what is important is not buying now, paying later, but instead saving now and buying right now as well. So if you want to buy something, you've actually saved enough money for you to actually acquire that. Some people say that if you have to take something out on finance, it actually means that you cannot afford it, which means you should not be buying it. And if you look at a lot of investment vehicles or credit vehicles, for example, if you were to buy a car and the car was, for example, £20,000 or $20,000, and you could actually buy it cash down for $20,000, or you could buy it with interest under credit, and you'll realize that that $20,000 would actually creep up to about $24,000 depending on interest rates. So you can see you're actually paying more. And if we also understand that year on year interest rates continue to go higher and higher, that actually means we're even paying more than what we actually think. So think about it like that. So I'm big on practicality. So how can you actually buy a big purchase? Because sometimes saving is incredibly difficult. Well, my answer to that is save in small chunks. They say if you want to eat an elephant, you have to take it on one bite at a time. In the same way, you could use the same analogy for a big purchase. Set up a pot, set up a savings account set up a high interest savings account, and put money into it. Slowly and steadily, you'll start to see the growth in that account. And eventually you'll realize, or even by the time you're ready to buy the big purchase, you might actually realize that there's something else that you prefer even more. So take the time, develop this type of mindset, because this is the same mindset that every single millionaire has. Number 2, setting no money at £10,000 or $10,000. No matter how bad you are with money, there comes a point where you no longer can make irresponsible, careless decisions, and you are forced to cut your spending to save money. And this is because you no longer have any access to money and you have no money, in quotes. The interesting thing about this is the idea of having no money varies from person to person. Many people believe that no money is when all of their credit cards are maxed out, all of their bills are behind, and their bank is charging them overdraft fees. They believe that having no money is when they no longer have any options. To avoid this toxic financial habit, start making decisions to cut spending and save money before you go to below zero. So to summarize this point, setting no money at minus 10,000 or minus 1,000 or even just minus £1 or $1 is you could quickly start to realize that you're actually in the danger of living paycheck to paycheck, meaning that you are absolutely reliant on that next paycheck coming in. And if it doesn't, you're up to your neck in credit cards, you're up to your neck in bills, you have no savings, so you were quote unquote broke. So getting out of this habit, getting out of this paycheck to paycheck, getting out of that and setting yourself a realistic financial expectation is key for a financial mindset. So some of the practical steps you can actually take to ensure that you have a realistic financial threshold and avoid getting into debt is you can actually have A high interest savings account, number one, that you don't touch. That's a fixed interest account that you don't touch. You don't see that money. It goes straight from your paycheck into the high yield savings account. And another option that you could use is you could actually pay yourself first. So worry about investments, but I only suggest you do this once you have a pot of either 3 months income or 6 months worth of expenses all paid for. So unless you have that in your savings account, then I would say start looking at investments. So whichever one comes first, whichever one you're able to do first, I'd say do that one first. Number 3, getting banks to tell you what you can afford. The financial crisis in 2008 happened because banks were lending money to people who couldn't afford to meet their monthly payments. This financial crisis was partly due to banks being irresponsible with lending, but it also occurred because people allowed the banks to tell them exactly what they could and could not afford. Time has passed, but the banks are still handing out money to anyone who is willing to take it, regardless if they can actually afford it. If you let the banks tell you what you can afford, you will probably be left with payments that make it impossible to get ahead of. To avoid this toxic financial habit, it is important to be responsible, look at your own financial situation, and decide what you can afford in your life. So banks have a formula, they have a calculation for assessing affordability. However, what this calculator doesn't present is how well someone is able to switch off what they like and what they don't like, meaning they can stop spending just at the click of a button. They can stop spending just like that. So sometimes they will look at your financial statement, they will look at your income statement, your ingoings, your outgoings, and then they will assess you based on how likely you are to default on whichever payment that is. So once they've made that decision now, that decision may not actually align with your reality, because you know well and truly yourself that you're able to stop spending here, stop spending there. However, your balance sheet, your bank statement does not represent that. What I do is I create a personal budget to determine what I can truly afford. The level of granularity here is much greater, as it shows me exactly what I can afford, and it shows not only my ingoings and my outgoings, but it also will explain some of the reasons why I bought some of the things I did at that time. For example, one month may have been very hectic because there was 5 birthdays in that month, a wedding that month, and also a bunch of bills that had to get reinstalled that particular month. For example, car insurance, car tax, insurances had to also come out as well in that month. So that's the type of context that I would have in my personal budget, so that I'm able to see what I truly can afford, and that gives me a better representation of what I can truly afford and what I need to be asking the bank for if I do need any credit. Number 4, paying yourself last. Now, this is definitely a normal money habit that keeps people poor. Many people are very selfless with their money. Once they get their paycheck, they give all their money to people, whether that's for paying the rent, a car payment, bills, or other payments. And once they have paid everyone, there is no money left for themselves. To avoid this toxic financial habit, it is important to determine a specific amount of money to set aside each paycheck to save or invest before you start paying your bills. When you do this, your bank account will consistently be rising. So as I said before, I'm big on practicality. One thing people could do is they could start to cultivate a pay yourself first, meaning that they pay themselves first before any bills are paid, before any financial obligations are paid out from their bank account. As soon as payday comes, that day or the day after, they pay themselves first, meaning they buy or invest in the things which will help them in their future. For example, into their pension account, into a ISA account, into a investment vehicle, or into something that will allow their wealth to continue to generate. Now, let's take this one step further. You'd actually be able to do this with automating your savings. So there's certain platforms that you can use which will automate your savings and your investments for you. So you don't even have to worry. You just need to set the date of your payday. And once you set the date of your payday, it would automatically come out of your bank account and go straight into the investment vehicle. So you don't even need to worry about it. That's just one thing less to worry about. In addition to this, if you are able to do this, you'll quickly realize how setting aside a fixed amount every single month will continue to compound itself. And as it continues to compound itself, the money you're making So for example, if you put £100 in every single month, that £100 the next month will be £200, and you're getting interest not only on the 100 but on the 200. So your money's actually growing at a faster pace. I've made another big video about compound interest. Please give that a listen, and that goes into far more detail if you still do not understand compounding interest. And number 5, not investing in the stock market. Now, studies have shown that most millionaires were created through having wealth in businesses and in the stock market. Many people are afraid of the stock market and choose not to invest because they think that they will lose all their money overnight. Instead, they put money in a savings account. While saving is important, if all of your money is just sitting in a savings account, you will lose money each year due to inflation. It is important to learn about the stock market and simple types of investment called index funds so that you can grow your money over time. Now, the reason why I keep going on about this is because index funds must be used within your investment portfolio. It's a must, and a lot of people do use it in their investment portfolio, and they have been able to acquire a lot of wealth. So you should do the exact same in order for you to acquire a lot of wealth. I do not want anyone who's listening to this video to be 30 years from where they are right now and say, oh, I wish I invested in an index fund, seeing all of the astronomical returns. But instead, I wish that all of you do your own research first of all and invest in a fund that is suitable for you. So again, for practical steps here, there are plenty, and I mean plenty, of financial websites and financial advisors who will offer you the right advice on where to invest your money. And there's also plenty of platforms that will allow you to invest in their ETFs, which is another word for index funds, which is ultimately just a pool of different companies or pool of different stocks in one particular market or share. So I want everyone to do something slightly differently with this video. I want you to listen to the video and actually act upon at least one thing that was mentioned in this video. These 5 habits can keep you financially stuck, but recognizing and changing them from as early as possible can set you on the right path to financial stability and success. Make sure to hit that like button if you found this video helpful, and don't forget to subscribe for more tips on managing your money better. See you in the next video.